Welcome to the deep dive. Today we're tackling something that can feel a bit like a maze, the Indian financial markets.
hmm
Our goal is really to cut through all that complexity. We want to give you a clear picture of how this whole system works, who the key players are, and why it's just so crucial for the Indian economy.
Yeah, and we'll be mainly drawing on insights from chapter5.pdf.
Mm.
Think of it as our guide for this exploration.
Exactly.
It's basically an express route to understanding the essential structure and the regulations that really make these markets tick.
Right. So if you've ever wondered what's really going on behind the headlines or just wanted a solid grasp of the fundamentals without, getting bogged down in jargon, then you're in the right place.
Hmm.
Okay, so let's start unpacking this. To kick things off, it's probably helpful to remember how the Indian economy itself has changed over time.
Yeah, good client.
It wasn't always the services and manufacturing hub we see now. It started out much more reliant on agriculture.
And as an economy grows like that
Yeah.
and diversifies, it needs a really strong financial system to, well, fuel that expansion.
Right.
That system acts almost like the circulatory system for the economy. It channels savings
Okay.
from individuals, from businesses,
Mhm.
and turns them into the investments and credit needed for more growth.
So you can kind of picture the financial markets as this, incredibly efficient network,
Yeah, exactly.
connecting people who have spare funds, the savers or investors, with those who need that capital to grow or invest, the borrowers, the businesses,
And there's a whole range of intermediaries in between.
like banks.
Banks, mutual funds, insurance companies.
Yeah.
They act as the facilitators, making those connections happen smoothly.
Got it. Now, you mentioned how these markets are categorized. That seems important.
It is. Broadly, you have the money markets first.
Okay.
That's all about short-term borrowing and lending. Think like less than a year.
Right.
Then you've got the capital markets. They focus on the longer-term stuff, funding through things like bonds and stocks.
And within those, there are primary and secondary markets,
Exactly. Primary markets are where new securities are created and sold for the first time.
like an IPO.
Like an IPO, yeah.
Yeah.
The company selling shares directly to raise money.
Okay.
Then the secondary markets are where investors trade those existing securities amongst themselves. That's your typical stock exchange activity.
But the whole financial landscape is even wider than just money and capital markets, isn't it?
Oh, definitely. You've also got vital commodity markets, really important for businesses managing raw material price risks.
Mm-hmm.
Then there are the foreign exchange markets, absolutely essential for international trade, letting businesses swap currencies.
Right.
And of course, you can't forget the insurance and pension markets. They provide financial safety nets and help people save for retirement.
Okay, that gives us a good overview of the terrain. Now let's dig into something fundamental. Regulation.
Yes.
It might not sound like the most exciting part, but it's basically the bedrock, right? Building trust, ensuring fairness.
Absolutely spot on. The core reason, really, for regulating financial markets is to protect investors.
Makes sense.
It's all about making sure people can make informed choices, that they understand how things work, and, importantly, the risks involved.
So who are the main referees keeping an eye on everything? Let's start with the big one, the RBI, the Reserve Bank of India.
Right. The RBI, they wear a lot of hats. They're the main regulator for commercial banks, for starters.
Okay.
They also set and manage our monetary policy, basically controlling the money supply and interest rates.
Right, influencing inflation and growth.
Exactly. Plus, they manage foreign exchange reserves, issue our currency, oversee payment systems. They even act as the banker to the government and other banks.
Wow, quite a remit.
Yeah, and their main goals are price stability, so keeping inflation in check, while also supporting economic growth. And under the RBI, you have the Board for Financial Supervision, the BFS, which specifically monitors various financial entities.
Okay. Next up, SEBI, the Securities and Exchange Board of India. They're the guardians of the stock market, right? And commodities, too.
That's right. SEBI's role is very comprehensive. They regulate the stock exchanges themselves. They register and oversee all the intermediaries, brokers, investment advisors, you name it.
Mm-hmm.
And a huge part of their job is preventing fraud and unfair practices, like insider trading.
So keeping the playing field level.
Precisely. They can investigate, conduct audits, push for investor education. It's all geared towards protecting investors and ensuring the market is healthy and transparent. When you hear about SEBI taking action, that's them doing just that.
Moving on to protection in a different sense, insurance. That's where the IRDAI comes in, the Insurance Regulatory and Development Authority of India.
Correct. IRDI is the watchdog for the entire insurance sector.
Okay.
They issue licenses to insurance companies. They have to approve the insurance products being sold. They set the rules for agents and brokers. And critically, they protect policyholders' interests.
So they look at the policy terms
Yeah.
and how things are sold.
Yes, they regulate the terms, the distribution channels, even how insurance companies invest the premiums they collect. And there's also the Tariff Advisory Committee under IRDI, which sets rates for some types of general insurance.
Got it. Then for our retirement savings, we have the PFRDA, the Pension Fund Regulatory and Development Authority.
Yep, PFRDA oversees the pension sector. This includes the National Pension System, the NPS, which has become really significant.
Why is that?
Well, they regulate the different pension schemes, approve their terms and investment rules, register the intermediaries involved, and crucially protect subscribers' interest, making sure retirement funds are managed well and costs are reasonable.
And educating people, too, I imagine, about saving for retirement.
Absolutely. That's a key part of their role, educating the public on why retirement saving is so important.
So we've got these main regulators, RBI, SEBI, IRDAI, PFRDA. But the government itself, the Ministry of Finance, must have an overarching role here, too.
Oh, absolutely. The Ministry of Finance is very significant. Through its Department of Financial Services, it oversees banking, insurance, and pensions.
Right.
And its Department of Economic Affairs handles capital markets regulation. The ministry is key in driving policy reforms and overseeing legislation.
This is like a huge responsibility, and you mentioned it has 5 departments within it.
Yes, 5 key ones. Economic Affairs looks at the big picture macro policy, capital markets. Expenditure manages government spending rules and state aid. Revenue, obviously, deals with taxes.
Okay.
Financial Services focuses specifically on public sector banks, insurance, pensions. And the 5th, Investment and Public Asset Management, handles things like government divestment programs.
Busy place. And besides finance, there's also the Ministry of Corporate Affairs involved.
There is. Their role is more about administering the laws that govern companies themselves. The Companies Act, the LLP Act, the Competition Act, making sure the corporate sector plays by the rules.
Oh.
They also supervise the professional bodies, like ICAI for chartered accountants, ICSI for company secretaries, and the other ICAI for cost accountants, setting professional standards.
And for the very basics of setting up a company, there's the Registrar of Companies, the ROC.
Exactly. The ROC handles the actual company registration process and ensures ongoing compliance with legal filing requirements. They're the official record keepers for companies.
One last piece in this regulatory puzzle, self-regulatory organizations, or SROs. What are they?
SROs are basically organizations formed by intermediaries within the securities market, think brokers, advisors, etc. They're recognized by SEBI, but they aren't the stock exchanges themselves.
So they regulate themselves to some extent.
In a way, yes. They register with SEBI, have obligations to SEBI and investors, and they play a part in maintaining industry standards. They might inspect their own members, report violations to SEBI. It adds a layer of self-governance.
Okay, that maps out the regulatory landscape quite well. Now, let's shift gears and look at the actual structure, the nuts and bolts of the markets themselves. Starting with, well, the backbone. The banking system.
Yes, the banking system is absolutely central. It's vital for growth because it handles financial intermediation.
Right, that channeling of savings into loans we talked about.
Exactly, taking savings from households, businesses, and making that capital available as credit for productive uses, expansion, home buying, etc. And as we said, RBI is the main regulator, with BFS providing supervision.
And the core function of a bank in all this, what do they actually do?
At their heart, they're intermediaries. They attract funds through deposit accounts.
Okay.
They assess borrowers and lend those funds out. Plus, they provide the plumbing for transactions, checks, transfers. And increasingly, they also sell other financial products like mutual funds or insurance.
We see different kinds of banks out there. Commercial banks are the main ones.
Yes, commercial banks are broadly split into scheduled and non-scheduled. Scheduled banks are the major ones you'd recognize. Public sector banks like SBI, private ones like HDFC, foreign banks, and also regional rural banks focusing on agriculture.
And non-scheduled.
Right now, those are mostly local area banks, operating in specific smaller regions.
And beyond commercial banks, there are other types. Cooperatives.
That's right. You have cooperative credit institutions, urban co-op banks, state and district co-op banks focused on rural areas, and then the newer models, like payment banks.
Ah, yes. Payment banks, they were for financial inclusion, right?
Exactly. Designed to bring more people into the formal system. They offer small savings accounts, payment services, targeting low-income groups, small businesses. But the key thing is they can't actually lend money.
Whereas small finance banks can lend.
Correct. Small finance banks are also focused on financial inclusion, providing savings, banking services, and credit specifically to small businesses, farmers, the unorganized sector. So they bridge that gap.
Now, we often hear about NBFCs, non-banking finance companies. They sound like banks, but they're different.
They are similar in that they provide loans, leasing, hire purchase, etc., but crucial differences. They can't accept demand deposits, your regular savings or current accounts.
Okay.
They can't issue checks drawn on themselves. And their deposits aren't insured like bank deposits are.
So why do they exist?
They often step in to fill lending gaps, maybe serve customers or sectors that traditional banks find harder to reach. And within NBFCs, you have specialists, like housing finance companies, focused purely on property loans.
Yeah.
They used to be regulated separately, but now they're under the RBI too.
We've also seen P2P lending platforms emerge, peer-to-peer.
Yes, peer-to-peer lending. It's basically individuals lending directly to other individuals or small businesses via online platforms.
Cutting out the middleman.
Sort of. The platform acts as the facilitator. It's usually unsecured lending, and these platforms are regulated by the RBI. They have to do due diligence on lenders and borrowers to manage the risks. It's essentially a digital loan marketplace.
Okay, let's shift to the money market. Short-term stuff, you said. What gets traded there?
Right. Money market is for instruments maturing in less than a year. Think things like call money overnight loans between banks,
Okay.
commercial paper, short-term IOUs from companies, certificates of deposit or CDs issued by banks, commercial bills for trade finance, and treasury bills, or T-bills, short-term government debt.
And who are the main players?
Mostly banks, financial institutions, and primary dealers who handle government debt issuance. It's a very liquid market, and the RBI is very active here, managing liquidity and influencing short-term rates as part of its monetary policy.
Another market that's critical, especially globally, is the foreign exchange market. Forex.
Absolutely essential. Forex markets are where currencies are traded. This allows international trade and investment to happen.
Right.
You have spot markets for immediate exchange, forward markets to lock in future rates, and currency derivatives traded on exchanges.
And who trades in the spot market?
It's split. There's the interbank market, where banks trade huge volumes with each other, and the merchant segment, where businesses buy or sell currency through their banks for imports or exports. And there's an entity called FBIL Financial Benchmark, India PVT Ltd., that publishes daily reference rates, which are important benchmarks.
Now, switching to credit again. Good information is key for lending. That's where credit information companies, CICs, come in.
Precisely. CICs are the backbone of credit reporting. They collect and maintain detailed credit histories for individuals and businesses.
Like Sybil.
Exactly. TransUnion Sybil is one. The others are Experian, Equifax, and CRF Highmark. Banks, NBFCs, other lenders provide data to them and then access reports from them to check creditworthiness when someone applies for a loan.
And they generate credit scores.
Yes, that single number summarizing credit risk.
Yeah.
And importantly, the RBI mandates that everyone can get one free full credit report from each CIC every year.
Good to know. And a newer thing are account aggregators, ADAs. How do they work?
ADAs are RBI licensed entities. They help you consolidate your financial data from banks, mutual funds, insurers, and share it securely with other financial providers, but only with your explicit consent.
So it makes things like applying for loans easier, less paperwork.
That's the goal. Streamline digital lending, reduce physical documents, potentially improve access to credit, because your financial picture is clearer, but always with you in control of who sees what and for how long.
Okay, let's pivot to the securities market now under SEBI's watch. First up, what exactly counts as a security?
It's defined quite broadly in the Securities Contracts Act. It covers shares, obviously, but also bonds, debentures, which are types of debt derivatives, mutual fund units, government securities, and really any instrument representing an investment or a claim on future income or capital. It's a wide net.
And we mentioned the primary and secondary markets earlier, just to recap.
Sure, primary market, brand new securities issued by companies or government to raise capital for the first time.
The IPO example.
Right. Secondary market, trading of those already issued securities between investors. This provides liquidity, the ability to buy or sell easily, and helps determine the price through supply and demand.
And the stock exchanges, like NSE and BSE, are key here.
Absolutely. They provide the electronic platforms for this secondary market trading. They use anonymous order matching, so buyers and sellers don't know who is on the other side, which helps ensure fair pricing.
But there's crucial infrastructure behind the exchanges too, right? Like clearing corporations?
Vital infrastructure. Clearing corporations sit in the middle after a trade happens on the exchange. They guarantee the trade gets completed.
Oh,
They confirm the details, manage the transfer of securities from seller to buyer, and the funds from buyer to seller. They also manage the risk, what happens if one side defaults. The clearing corporation steps in.
okay. Essential for trust. Then we have depositories, NSDL, and CDSL. What's their function?
Depositories are like electronic vaults for securities. They hold shares, bonds, etc. in dematerialized or demat form.
So no physical certificates.
Mostly, no. It makes holding and trading securities much safer, faster, and more efficient. Your ownership is just an electronic entry in your account with the depository, like a bank account for your shares.
And how do we interact with them? Through depository participants, DPs.
Exactly. DPs are agents of the depositories. Your bank or your stockbroker usually acts as your DP. You open your demat account with a DP, and they handle the electronic transfers when you buy or sell securities. They're the interface.
Okay. Now for bigger players, institutional investors, there are custodians.
Yes. Custodians are typically large banks that provide services to institutional investors like mutual funds or foreign investors. They hold the securities safely, manage the associated bank accounts, handle settlements, track corporate actions like dividends. It's a specialized safekeeping and administrative service for large portfolios.
And most of us need stockbrokers to actually trade, right?
That's right. Stockbrokers are the registered members of the exchanges authorized to place buy and sell orders for clients. Many also offer research, advice, and the online platforms we use for trading. They earn a commission for executing trades.
Beyond shares, there's the bond market. What's traded there?
The bond market is where debt securities trade, government bonds, corporate bonds, debentures. When you buy a bond, you're lending money to the issuer. They promise to pay you back the principal plus interest over time. It's crucial for long-term fundraising and offers investors a different risk-return profile compared to stocks.
And then the derivatives market. Sounds more complex.
It can be. Derivatives are instruments like futures and options. Their values derive from an underlying asset, a stock, bond, currency, commodity index, whatever.
Why use them?
They offer leverage. Small price moves in the underlying can mean big gains or losses. They can be used for hedging risk, like an airline locking in a fuel price, or for speculation betting on price movements. But yeah, they are complex and carry significant risks. Need to understand them well.
Mutual funds seem a much more common way for people to invest now. How do they fit in?
Mutual funds are basically pools of money from many investors.
Okay.
A professional fund manager takes that pool and invests it in a diversified portfolio, stocks, bonds, etc., according to the fund's objective. They're a great way for smaller investors to get diversification and professional management without picking individual stocks themselves. Key intermediaries, really.
And if you need help deciding which funds or investments, there are investment advisors.
Yes. Investment advisors provide personalized guidance. They look at your goals, your risk tolerance, how long you plan to invest, and help you build a suitable portfolio. Especially helpful if you're new to investing or dealing with complex products.
We also hear about AIFs, alternative investment funds. How are they different from mutual funds?
AIFs are also pooled funds,
Hmm.
but they cater typically to more sophisticated or high net worth investors. They have more flexibility in what they can invest in: private equity, venture capital, hedge funds, real estate, complex strategies. Not usually for the average retail investor, but a growing part of the market.
For everything to run smoothly, verifying identity is key. That's KYC and KYC registration agencies, KRAs.
Exactly. KRAs handle the Know Your Customer process.
Okay.
Instead of doing KYC separately with every bank, broker, mutual fund.
It's just a pain.
Right. You do it once through a KRA. They verify your identity and maintain a central record. For individuals, it's called CKYC. Once you're registered, other regulated entities can access that verification, with procedures, of course. It streamlines onboarding significantly.
And for assessing the risk of bonds, we have credit rating agencies.
Yes. Agencies like Crystal, RA Care Ratings, they assess the financial strength of companies or governments issuing debt. They assign ratings like AAA, AAB, etc., indicating the likelihood of the issuer repaying their debt on time. Helps investors gauge the credit risk.
Okay. Then for big corporate deals raising capital, M&A, there are investment banks.
Right. Investment banks advise companies on major financial strategies. How to raise capital, issue stock, issue bonds. Should they merge with or acquire another company? They structure and execute these large, complex deals.
And managing the investments themselves, asset management companies and portfolio managers, what's the distinction?
Asset management companies, or AMCs, are the ones that manage mutual funds. They employ the fund managers who make the investment decisions for the schemes. Portfolio managers typically offer more customized services, managing bespoke portfolios directly for individual wealthy clients or institutions, tailoring the strategy specifically to them. Both charge fees for their expertise.
Last piece in the securities infrastructure, registrar and transfer agencies, R&Ts.
R&Ts handle the essential investor servicing and record keeping, especially for mutual funds and company shares. Things like processing applications, sending out account statements, handling dividend payments, managing shareholder communications, processing transactions. They're the administrative backbone for investor interactions.
Okay, deep breath. That covers the securities market. Let's move to another vital area, insurance, regulated by IRDAI. What's the shape of the industry in India?
It's mainly split into two big segments: life insurance, financial protection against death, and general insurance, which covers basically everything else.
Like health, motor.
Exactly. Health, motor, property, travel, liability, etc. The life insurance side, interestingly, was open to private companies back in 2001, which led to a lot more competition and product innovation.
And within life insurance, what are the main product types?
Broadly, you have traditional plans, term insurance, pure protection for a period, endowment plans, protection plus savings, whole life plans, lifelong cover. Then there are variable plans where the policyholder bears investment risk, and unit-linked insurance plans, ULPs, which combine insurance with market-linked investments.
How are these sold?
Through various channels. Individual agents are still very common. Bank insurance banks selling insurance. Direct sales by the company. Insurance brokers who represent the customer. Corporate agents. Lots of ways.
And general insurance just covers a huge range.
A massive range. Motor and health are the biggest segments, but also travel, fire, marine, personal accident. Lots of specific policies for different risks. And the sector also involves brokers, agents, surveyors who assess losses for claims, and third-party administrators, TPAs, especially prominent in handling health insurance claims processing.
Right. Finally, let's look at pensions, regulated by PFRDA. What's the landscape there?
The pension market, particularly the National Pension System, NPS, has grown significantly. Key drivers are an aging population and the need to cover the large unorganized sector, which often lack formal retirement savings.
And the government structure changed too, right?
Yes, there's been a big shift away from defined benefit schemes, where your pension amount is guaranteed, towards defined contribution schemes, where your final amount depends on contributions and investment returns.
Like the NPS.
Exactly. The NPS is the prime example of a defined contribution scheme. It's voluntary, available to government employees and the general public. You contribute, choose your fund manager and investment mix within options, and build a retirement corpus over time. For the formal private sector, the Employee Provident Fund Organization, EPFO, is still the main player for mandatory retirement benefits.
So, stepping back from all these details, it's clear the Indian financial market is, well, incredibly complex, but also absolutely vital.
It really is a multi-layered, highly regulated ecosystem, and it's fundamental to India's economic journey, acting as that essential bridge between savers and borrowers, using all these different instruments and institutions we've talked about.
And understanding the roles of those key regulators, RBI for banking and monetary policy, SEBI for securities, IRDI for insurance, PFRDA for pensions, plus the structure of the markets themselves, it's really crucial to get a handle on how the whole thing operates.
Absolutely. We hope this deep dive has given you, our listener, a solid foundation, a clearer map of this complex but incredibly important territory.
Definitely. And maybe a final thought to leave you with. Consider how all these different parts, banking, securities, insurance, pensions, are interconnected. How does that web contribute to stability, but also maybe create potential risk in the wider economy? And on a personal level, how are your own financial choices influenced by this huge dynamic system? Something to ponder. Thanks for joining us on the deep dive.